Today, we will talk about interest, definition and types of fees for borrowing money. Interest is the monetary charge for the privilege of borrowing money. It can be expressed as a dollar amount, while the interest rate used to calculate interest is typically expressed as an annual percentage rate. It is the amount of money a lender or financial institution receives for lending out money. Interest is the concept of compensating one party for incurring risk and sacrificing the opportunity to use funds while penalizing another party for the use of someone else's funds. For example, when you leave money in your savings account, your account is credited interest because the bank uses your money and loans it out to other clients, resulting in you earning interest revenue. Interest is an ancient practice, and it became widely acceptable during the Renaissance. It wasn't until this time that money began to be considered a commodity, and the opportunity cost of lending it was seen as worth charging for. Today, interest rates can be applied to various financial products including mortgages, credit cards, car loans, and personal loans. In its most basic form, interest is calculated by multiplying the outstanding principal by the interest rate. The more complex aspect in calculating interest is often determining the correct interest rate. The interest rate is often expressed as a percentage and is usually designated as the APR. Often, an annual rate must be converted to calculate the applicable interest earned in a given period. Two main types of interest can be applied to loans: simple and compound. Simple interest is a set rate on the principal originally lent to the borrower, while compound interest is interest on both the principal and the compounding interest paid on that loan. Compound interest is the most common type of interest. Interest can be earned or paid in countless ways, including mortgages, credit cards, car loans, private loans, savings accounts, and penalty assessments. Paying interest is a relatively low expense compared to alternatives. It also means holding debt, building a credit history, and potentially using leverage. However, it is a recurring cash expense, and having too many loans and high monthly payments may restrict a borrower from being able to take out more credit. Collecting interest often provides positive cash flow and is a simple form of passive income. However, interest revenue is taxable, and there may be greater earning potential had you utilized the capital yourself. There is also philosophical opposition in some cases, such as student loan debt assessments. A low-interest rate environment is intended to stimulate economic growth, benefiting consumers and banks. However, low interest rates aren't always ideal as there are lower returns on investments and more chance of default when rates go back up. Interest rates are highly dependent on macroeconomic policy dictated by the Federal Reserve's federal funds rate. Accrued interest is interest that has been incurred but not paid. For a borrower, this is interest that is due for payment, but cash has not been remitted to the lender. For a lender, this is interest that has been earned that they have not yet been paid for. Interest is often accrued as part of a company's financial statements. The best way to earn interest is to properly research the risk profile of your borrower. The amount of interest paid by bank accounts will widely vary based on prevailing government rates and macroeconomic conditions. The amount of interest paid by bank accounts will widely vary based on prevailing government rates and macroeconomic conditions. For example, during the COVID-19 pandemic, while the federal funds rate was low, interest rates on bank accounts was near 0%. Then, as the pandemic eased, bank accounts began paying interest greater than 2% on bank deposits. Interest is a critical part of our high-functioning society. It encourages spending and ensures that capital is put to use, either by being borrowed or lent. The Federal Reserve's federal funds rate plays a crucial role in shaping interest rates and influencing macroeconomic policy. Here are 5 key takeaways. 1. Interest is the monetary charge for borrowing money, generally expressed as a percentage, such as an annual percentage rate, APR. 2. Interest may be earned by lenders for the use of their funds or paid by borrowers for the use of those funds. 3. Interest is often considered simple interest, based on the principal amount, or compound interest, based on principal and previously earned interest. 4. Interest is often associated with credit cards, mortgages, car loans, private loans, savings accounts, or penalty assessments. 5. Interest is highly dependent on macroeconomic policy dictated by the Federal Reserve's federal funds rate. Hope this would help. Thanks for watching.